Evening, class, and welcome to our advanced taxation class for today. Today, we are talking about capital gains tax, part 2. Today, we will be talking the last scenario that can play out without gains tax has been discussed, which is rollover relief. But before we do that, let's look at what happens when an asset is lost or destroyed. Now, in section 19 of the Capital Gains Tax Act, it says that if a capital sum is received by way of compensation for the loss or destruction of an asset, whether under a policy of insurance or not, a relief is available to the owner if the amount is applied within 3 years of receipt in acquiring a replacement of the asset lost or destroyed. So what it means that if you receive money for your asset that is lost or destroyed, let's say the house is burnt by fire, and now whether there is an insurance policy or not, and you receive compensation for that asset that was destroyed. Now, within 3 years, if you buy and replace these assets, you will have a relief, meaning that you will not suffer capital gains tax. But if it is above 3 years, then it's possible you will be charged capital gains tax. Now, the owner can claim A, as if the consideration for the disposal of the assets were of such amount as would secure that neither a loss nor a gain accrued to him on the disposal. So the money he received will be treated as if he didn't make any gain or loss in the disposal. The owner can claim as if the consideration for the acquisition of the new assets were reduced by the excess of the amount of the capital sum received together with any residual value or scrap value over the amount of the consideration which is treated as receiving under paragraph A above. So I just wanted to bring this point down, but that's not much of a problem. Now, when we get to rollover relief, we will also understand that clearly. Now, rollover relief. What is rollover relief? Now, before I talk about rollover relief, if you will remember, where else you'll be seeing the word rollover is when you are dealing with your internet data. Now, let's say you are subscribing to a particular network. I don't want to promote any network. Let's say the company's name is XYZ, and you are using their data. And now maybe you subscribe for, let's say, 50 gig a month. Then you subscribe on the 1st, and it's to expire on the 31st. They keep telling you maybe 5 days to when your expiration date will be. Please, your data will expire on the 31st. Please renew or buy the same plan to roll over any unused data. Now, if you were to ignore that warning and you decided to either buy a higher or a lower plan, that data plan that you have it's possible that you are not going to roll it over. Now, I just want to bring that idea to explain what rollover is. Now, when we add relief to it, now what is relief? Relief is something that, gives you, eases your pain or eases your tax burden. So if there is a rollover of your tax burden, then it's going to be something welcome. Now, how does rollover relief work? Now, if the consideration received on disposal of an old asset, so the key word here is disposal of an old asset. If the consideration that you got from this old asset, let me use this example now. This is a house, although I wrote it as circle, it's a house. It was bought at Ikeja in Lagos State. That's the capital of Lagos State. Now, if it was bought at Ikeja and it is used for letting office spaces, okay? Now, if you decide to sell this house, and let's say you receive 100 million. Now, if the consideration you receive on the disposal of this Ikeja house used for the purpose of trading is applied in acquiring a new asset in replacement. So now, you now use this 100 million to buy another house at Ikoyi. Okay. So if you are buying it, acquiring a new asset in replacement to be used for the purpose of trade, and the old assets and the new assets are within one and the same class of the assets. So this is a house, this is a house. You cannot sell your house and use it to buy a ship. They are not of the same class. Now, if they are of the same class, the person carrying on the trade shall, on making a claim as respect the consideration which has been so applied, be treated for capital gains tax purposes, as if the consideration for the disposal of the old assets of such amount will secure on the disposal neither loss or gain accrue to him. Well, let me go away from the jargons that is being stated here, legal jargons. Now, let me tell you what is this. Let's say this Ikeja house, the cost of acquisition was, okay, let me say the cost of acquisition was 100 million. 100 million. And you sold it for 150 million. Now, normally, 50 million would have been 50 million would have been capital gains, right? And so your capital gains tax would have been 5 million. That is what would have been the case. But now you decided to buy a house in Ikoyi here for 150 million. Now, you are going to roll over the capital gains from this house to this house. Now you could decide that you want to buy, instead of buying a house at Ikoyi, you want to buy a house at Ikosi. And now the house at Ikosi is 120 million. You are still doing something, you are still doing a kind of rollover. Or you could decide that instead of investing in Ikoyi or Ikosi, you decided to invest at Ikorodu. And now it is costing you 50 million. We're going to look at the various types of rollover that you would have achieved. I decided to play on words here because all these names are all beginning with IK. And so maybe the man's name is IK and he's decided to play all these tricks. Now let's look at the rollover that will be given to you. And I will be explaining what this rollover relief is. Okay? So we will be looking at a question. But before I go into that, I'll be doing the same thing here. We're doing that diagram here. This is your Ikoyi house. This is your Ikeja house. Cost of acquisition, 100 million. Sales, 150. This is Ikoyi. New purchase. This is 250. Now, in this case, let's analyze this. This is greater. It is greater than the sales. It's also greater than the cost of acquisition. In this case, you will get full rollover. I will explain. Now you decide that instead of Ikoyi, you went to Ikeja. You have new purchase. It is for 120. So now this is less than sales proceed, but greater than cost of acquisition. You are getting partial rollover. This is because it is still greater than cost of acquisition. That is why you are getting a partial rollover. But now you decided to go to Ikorodu and it's for 50 million. Now this is less than sales proceed, less than cost of acquisition. You have no rollover. We're going to discuss that as we take the question. So when we take the question, I will be liking which he acquired 10 years ago for 500,000. Now, this is the sales proceed. I'll be getting it here. So this is the sales proceed. So this is the sales proceed. The cost of acquisition as at that time. So this is cost of acquisition was 100,000. He acquired a new factory. So this is new purchase for 750. So this is like selling Ikeja house to buy an Ikoyi house to enable him carry on his business. So now this is like Ikoyi. Now, for the purpose of CGT, and upon Mr. Niger making a claim, he will be treated as if a loss, neither a loss nor gain accrues to him on disposal. That is, the proceeds of disposal will be taken to be equal to the cost, which is 100,000, and therefore no capital gains tax is payable. Okay, I will explain that. No capital gains tax is payable. So note down here, no capital gains tax is payable. Okay. Now, 2, as if the cost of acquisition of the new assets, 750,000, were reduced by the excess of the amount actual proceeds of the disposal of the old assets, 500,000, over the amount of the proceed which is treated as receiving under paragraph A, which is 100,000. That is 400,000. So, which would otherwise be the capital gain on disposal will be deducted from the cost of the new asset. I'm going to explain that now in the solution. Now, look at how you are going to be solving this. Let's crystallize out the situation here. This is illustration 13.2. Illustration 13.2. So we have, let me put them in chronological order. First of all, we have cost of acquisition. That's the first thing you had. You bought the house, 100,000. Then cash, okay, sales proceed. You now sold the house for 500,000. Then this is new investments. This is 750,000 naira. All right, so that's the case now. So what do we do? So this is how you are going to handle it. We put a 2 naira sign here. So you start. Cash received on disposal. How much was the cash received on disposal? Was 500,000, right? So you're going to less cost of acquisition, old assets. Now, I'll always be using this old assets as an emphasis, which is this 100,000. All right? When you less it, you are getting 400,000. Now, normally, this 400,000 is supposed to go for capital gains. So this is capital gains. Okay, I'm not going to underline it now. Now, this is supposed to be capital gains. You are supposed to find capital gains tax of 400,000, which is 40,000. But you have reinvested. You have reinvested. So look at reinvestment. Reinvestment will make you roll over. So amount reinvested. Reinvested. Now, how much is the amount reinvested? You bought a new asset for 750,000. Meanwhile, the old asset was sold for 500,000. Now let's reason it like this. You sold your house, which you bought for 100,000 for 500,000. You made 400,000 naira gain. You have 500,000 in your hand or in your bank. And you want to buy another house for 750,000. How much did you reinvest? Take note, reinvest is different from invested. Note here that amount reinvested is the lower of new investments. New investments. How much is a new investment? 750,000. 750,000. This is the new investment. Then cash received from disposal was 500,000. And we said the lower is the amount reinvested. So amount reinvested is simply 500,000. Now, why did we say amount reinvested is 500,000 when you invested 750? Now, when we say reinvest, it means you had money and you reinvest the money. So what it means that even though you bought a new asset for 750, it is taking that the 500,000 you received is inside the 750. It means that you only added 250, which is a new investment, a fresh additional investment. Additional investment is just 250. It means that the 500 you receive, you reinvested it. That is why we call it amount reinvested. So amount reinvested is the lower of whatever you receive versus whatever amount to spend on the assets. So it means the 500,000 you received is inside the 750. So assuming that it was 450 that the asset was bought, amount reinvested would have been 450, because it would mean that you took 450,000 out of the 500 that you received. You took 450,000. But now you bought it for 750. It is assumed that the whole 500 is inside the 750 you bought the assets. And so that is why we call it reinvested. So this is the amount reinvested. Reinvested is 500. Then you will say less cost of acquisition. Always the old asset. So Because you have not charged capital gains tax on that first asset that you have disposed on, in the eyes of the law, the asset is still in existence. This is just merely a replacement with a new asset. So the cost of acquisition will now be 100, which is the same thing that you have the other side. And what you now have here is capital gains rolled over. So you know here 500 minus 100, of course, is supposed to be 400 as before. So you come here and bring the 400 here, but this time it's going to be in brackets because it is rolling over. Now, if you look at it here, 400 was here, and you are rolling that 400 over, meaning that you are no longer capital gains chargeable. So this is capital gains is nil. So capital gains tax 10% is still. This is because house you more than you got from the old display. So I want you to always think of it using that Ikoyi house. If you spent more or exactly everything that you got, if you spend everything that you got and more, you're always going to get a full rollover. So this is capital gains rollover. I will say this is full rollover. This is a full rollover. Now I want to treat this same question as if it were to be an Ikeja house. So let me create this scenario again. Now, let's create this same scenario. The cost of acquisition is 100,000. The sales proceed is 500,000, but the new investment is 450 as against 750. Okay, so that's the only difference. So now let's see how this can be done. So this is like the Ikeja house. So you will start. This is cash from sales or disposal. That's 500,000. Cost of acquisition, old assets is still 100,000. And of course, 400,000 is your capital gains. Now the question is, will these capital gains be rolled over? If so, will the full amount be rolled over? If that is so, like in the first example, it is a full rollover. If part of it is going to be rolled over, then it is partial rollover. So let's watch. Then the next thing you want to do now is you want to look at the reinvestment amount reinvested, which is going to be the lower the lower of sales proceed, which is 500,000 versus new investments, which is 450,000. So you are picking the lower. So let's pick the lower. So therefore, amount reinvested is going to be 450,000. So less cost of acquisition, still the old assets, 100,000. What's the difference here now? It's going to be 350,000. So we call it capital gains rolled over. So it means that it's just like your data. Yes, out of 400 that you have to be rolled over, you had a chance to roll over 400, you managed to save and roll over 350. So 350 is, 350 is the amount rolled over. And so the difference between 350 and 400 is 50. So the 50 you could not roll over is your capital gains chargeable. So this 50 is what is being charged. As against the 400, you've managed to save 350 from being charged. What is going to be charged now is only 50. So this is an example of partial. You only save parts. You couldn't save everything. And so your CGT at 10%, this is 5,000. So you see now, normally in the first one, your capital gains tax supposed to be 400,000. 10% of it should have been 40,000. But now you saved 35,000 out of this supposed 40,000 that you would have been paid. You have saved 35,000 by rolling over 350,000. And now you only charge 5,000. Now that's the second scenario. So this is what you get when you leave, you sell an Ikeja house, and you get to buy a Ikosi house. Now let's treat the case of Ikorodu. Let's treat the case now of Ikorodu. So this is a cost of acquisition. We bought it at 100,000. Sales proceed is 500,000. New investment is 70,000. All right. Sorry, this is supposed to be 500. Let me write it well. It's 500. All right. So cash received on disposal plus that's 500,000. We are lessing cost of acquisition, old assets. Say old 100,000. Okay. So this is 400,000 is your capital gains, right? So the next thing to do is to find out your amount reinvested. And I said is the lower of cash on disposal, which is how much? 500,000. This is the amount you received, 500,000, or new investment. You invest only 70,000. So what it means is that out of the 500,000, it's only 70 you reinvested in the new assets. So therefore, amount reinvested simply 70,000 less cost of acquisition, old assets. It is going to be 100,000. So what would that be? 70 minus 100. So this is capital gains rolled over. Now 70 minus 100 is going to give me minus 30. Now, normally, we usually have a positive figure here. But because the cost of acquisition is higher than the amount reinvested, I am tempted to come here and put positive 30,000. If we do that, you're going to be adding 30 to 400 to be 430. But that's not the way to treat it. Now, whenever you have a negative value here, it means that there was a no rollover. So your capital gains rollover is going to be nil, meaning that you could not roll anything over. So rollover is supposed to be a positive figure here and negative here. But if it's negative here, that means you can only take 0. Therefore, capital gains chargeable is 400,000. So it means this is a no rollover. So it means that the 400,000 that you had here, you couldn't save any of it. You couldn't roll it. You couldn't save it. By all your sales, you couldn't sell it, save it. So now you are paying as if you never bought a new asset. So your capital gains tax at 10% is going to give you 40,000. So this is what happens when you sell your Ikeja house to go and invest in an Ikorodu house. So I have expanded that question to try all these 3 scenarios so that whenever you see any question on capital gains tax and you are feeling that it's going to be a rollover question, it will be any of these. Okay, so all right, so let's go. Now look at class of assets. We have class 1 assets. There are two types. Class 1A is land and building and any permanent or semi-permanent structure in the nature of a building occupied only for the purposes of trade. Class 1B is fixed plant or machinery. Now, class 2 is ships. Class 3 is aircraft. Then class 4 is goodwill. So now, the thing here is when we are treating capital gains tax, it could fall in any of these class. And if you are disposing that class, you must get the same class. If over a period of ownership or any substantial part of the period of ownership, a part of a building or structure is partly used for the purpose of trade, this section shall apply as if that the part used is a separate asset. So it means that if you have twin towers occupying one, not for the purpose of trade, giving out one for let, it is taken as you are occupying is a different asset. The part you are giving out for let is a separate asset. And so there will be necessary proration. Of course, there will be a valuer who will value the part that you are giving out for let, and that will be the major concern. Okay. Mention some of these artificial okay. I think we've covered the major things that is going to be useful for your exams. So let's look at examples now. Best Manufacturing Nigeria is engaged in the production of building materials at Ota, Ogun State. Due to sudden power surge at night, one of the factories got burnt before firefighters arrived at the scene. The factories were completely insured with Macon Insurance Company PLC. The management decided to move the factory from Ota to Lagos. Concerted efforts were made to acquire land for the new factory in Ejibu. And the factory in Ota that was not burnt, and the factory in Ota that was not burnt, which costs 1,800,000, was sold for 4,000,000 in March 2007. So the amount formed part of the cost of construction of the new factory at Ejibo, which was completed in November at a cost of 5,600,000. So what happened here is that we'll look at the solution from ICANN. In 2008, for the Ota factory, all these plating names, I seem to be getting confused. Let's try and crystallize it. We are told that power surge at night, one of the two factories got burnt. So let me draw the factories. This one burnt. And this one not burnt. So both of them were at Ogun State. So this is Ogun State. Okay. Then the management moved to Lagos and they bought a new land here in Ejibo. So its cost of acquisition was 1.8 million, sold for 4.2 million. Part of the whole thing that was new investments is 5.6 million. 2 was used as reinvestment for this 5.6. Okay. In 2008, cost for the factory, for the Otta factory, costing 3,700,000. The insurance company paid 5.9 million to Best. So this one here, it was 3.7 cost of acquisition, but they received 5.9 million. Out of the compensation received, 4.6 was spent in the construction of the new factory in Ejibo. So what it means here is they got 5.9 here, 5.9, and they reinvested 4.6. Here is 4.6, and this is 5.6 that was the new asset now. So that means the remaining 1 million came from here. 1 million. So out of this 4.2, 1 million was reinvested. 4.6 out of this 5.9 was reinvested. Okay. Whilst the balance was put in a fixed deposit to yield interest. Best Manufacturing has just appointed you as the company's tax consultant. Now, advise the management on capital gains, if any, arising from the events. The capital gains tax payable. How the company can reduce capital gains tax payable. Now let's see what let's see how this was sorted out. Okay, so let me get to the solution. How it works here. Now look at it now. Look at the advice you have to give. November 15, 20. Director, Best Nigerian Company at Ejibo. Advice on tax implication of disposal of property or insurance claims received on destroyed property. We are in receipt of your letter dated November 5, 2009, appointing us as your company's tax consultant and specifically requesting for our advice on the following underlisted areas. Capital gains, if any, arising from the transaction, capital gains tax payable, and suggest on ways of reducing the capital gains tax. So you are stating advice. So that's a good way. After thorough examination of the information provided in your letter under reference, we state as follows. In respect of item A, Appendix 1 shows the capital gains for assessment years 2007 and 2008. We'll see that. For the assessment year 2007, we're going to be duplicating so that I'll get to that assessment. I'll get to that appendix so that as we are talking, we'll be looking at it. Okay, so we are reading for the assessment year 2007. Why is it 2007? This is because the management moved from factory to OTA, and the OTA farm or OTA factory was sold in 2007. And that's why we have year of assessment 2007. We said it's an actual year base. And in 2008, insurance company paid. And out of that, compensation was spent. Out of the compensation that was received, you spent some amount of money. So we have 27 and 28. So that's why we are saying 27 and 28. For the assessment year 27, your company is not liable to capital gains tax for the facts stated under Appendix 1. While for assessment year 2008, the capital gains tax is 130,000. So you see, you would have done your workings and be putting the values there as shown under Appendix 2. So we'll come to this number 3. So let's look at Appendix 1 and see why 2007 had no tax. So capital gains tax, disposal of OTA warehouse, sales proceed is 4.2. Let's see, 4.2. So the factory that was not burnt, 4.2 was received. So that's what is here, 4.2 less cost of acquisition. It costs 1.8. So that's it. So when you less 4.2, 1.8 from 4.2, we get capital gains of 2.4 million. Now, this is deduct rollover relief, but I call it amount reinvested, okay? It's still the rollover relief we are talking about. We are going to deduct rollover. Now, I said amount is the lower of your cash proceed and the new investment. Now, your cash proceed is 4.2 million, which is this. And this 5.6, is how much you spent in the new investment. So it's 5.6 you spent there, but you actually received 4.2. And so you took the lesser one. Okay? 4.2 is the lower one. This thing is not formatted well. So it means it is 4.2 that you take. Then your cost of acquisition is still your 1.8. And when you minus it, you are getting 2.4 as before. Then you roll it over to here. And so this is the example of the full roll over. And so this minus this, you are having nil. So it means that they said the company is not liable to capital gains tax because of the full rollover. The amount you reinvested is smaller than how much you actually invested. Now, we would like to do for the reason the amount reinvested. I think they are getting this meaning twisted. The amount invested is greater than your sales proceeds, which was reinvested. You are getting the word twisted here. For something to be reinvested, it means you must have received money and put it back So it is the sales proceed that is reinvested. Your new investment. So what I will tell you is the amount invested, not reinvested, amount invested is greater than the sales proceed. It is this sales proceed that was reinvested. The amount from sales proceed is inside this new investment. It's inside this new investment. And so that's it. Full rollover will be claimed. Now look at the second one now. Disposal of factory in order. Now we have claim from the insurance. We are told that the insurance people paid 5.9 million. The cost of acquisition is 3.7. And so your capital gains is 2.2. Here they wrote it, but this is here supposed to be. Now the rollover. So the amount invested, how much was invested? 4.6. So out of this 4.9, 4.6 came into here. So 4.6. Now, sales proceeds is 5.9. Normally, you're supposed to do it here. 4.6, 5.9. What we win here is 4.6. Then you are going to bring your cost of acquisition. So 4.6, 3.7 will give you 100. So it is 900 and it's supposed to roll over. 2.2 minus 900 gives me 1.3. That's your capital gains. So your capital gains is 1.3, and of course, your capital gains tax will be 1. What they said here, 130. Now, if you look at it now, total gains made on the project. 7, disposal of warehouse, they got a of 2.4 that was completely. In the second year, 2.2 factory. Now, capital gains tax, see that. Now, they said your capital gains tax. Okay, so we'll come back to that one. Ways to reduce. They said in order to reduce the capital gains tax, the full proceed of 5.9 should be applied to eligible factories so that the company can benefit from the full rollover relief in 2008 assessment year. So you see this 5.9, they only reinvested 4.6. If they have reinvested, they would have a full rollover, and this 130 will not have been paid. That is what we are saying here. So let's see here. In our opinion, for your company to have a reduced liability on capital gains tax, the full proceed of 5.9 should be applied to eligible factories, thus having the benefit of a full rollover relief in 2008. So it's the same thing. We have based our company law. Asset lost or destroyed and replacement of business assets. So the assets lost or destroyed. So this insurance gave them 5.9 million. So it is taken as the consideration for selling that asset. Now, relief or reinvestment of disposal of similar assets. So that's why we got a full rollover relief. Now they said the mandatory period of 12 months of disposal of old assets within which reinvestment occurred. So when you sell off the old assets, you have 12 months within which you must buy asset of a similar class for that rollover relief to occur. It's just like saying that you have a data that you need to roll over, and they give you the validity period. If you don't roll over within this period, you are going to lose that offer. And so in this case here now, it is 12 full months. As shown in our computations, your company was liable to capital gains tax in 2008 because the amount of investment was less than the claim proceed. All right. So I guess you understand that point now. So if the amounts you are investing in the new assets, the way I like to call it, new investment is bigger than the money you receive as sales proceeds from the old assets, you have a partial rollover. It's only parts that you can roll over. But if the money you received is lesser than the amount you invested in the new assets, then you have a full rollover. All right. Okay, so this is the appendix 1, 2, 3, and all that. So let's look at another question. Janid Investment Limited sold its 2 buildings situated on Lagos Badagry Expressway, Amuwo, Lagos, and another in Ibadan. So I think you need to be drawing sometimes so that you don't get yourself confused. So sold its 2 buildings. So this is one here. This is Lagos Badagry. Then this one is Ibadan. The building in Lagos was compulsorily acquired by the state in 2008 in the course of dualization of the road. A compensation, so this like sales proceed, of 25 million was paid for the building, which originally cost the company, which is cost of acquisition, 2.5 million. Fearing that the same predicament might befall the Ibadan building, the company quickly sold the building for, okay, so this one was 2008, and the same one for 2008. So we have same year. The company quickly sold its building, so sales proceed is 15.5 million on July 6. Its original cost of acquisition is 850,000 naira. The sales expense amounted to, so this 15.5, you are going to less incidental expenses amounting to 3.25 million. The company normally makes its account to 31st December each year, and the properties which were sold and purchased were reflected in the accounts to December 31st, 2008. The company decided to move to Ogun State, where between September and November 28, it acquired. So this is a new place in Ogun State. He acquired a new site and erected another building. So this is new investments for 20.5 M required. Computes the capital gains tax liability for the relevancy of assessments and states one other alternative open to journeyed investment. Let's see how this was treated here by ICANN, and I'll explain their treatment. Now, if you see how it is being treated, for the same 2008, we have compensation and sales price. So this Lagos Ibadan, Lagos building, this Ibadan building. How much did Lagos receive? Now, Lagos received 25 million. So that's the 25 million here. For Ibadan, they quickly sold it for 15.5 million. That's what is here. Now, there's sales expense which you need to deduct in that of Ibadan building, which is 3,250,000. You remember we wrote it down here. And so the net sales or compensation is 15,500,000 minus 3,250,000. So, and this one has nothing. So this is the net 12.25 million, and this is still 25 million. Then you need to bring the cost of acquisition, and I wrote it here. This is 2.5. That is it here, 2.5. Sorry, that's this 2.5 here. And the other one here is 850,000. That's 850,000. So when you do that, 2.5 away from 25 million, you have 22.5 million, and you have 11.4 million. Okay. Now, that's your capital gains. Okay. Right. So now, this is the new investments. So capital gains tax here is said to be nil, and here is said to be sorry, and here is said to be 1,140,000. So what it means here is that when they sold the Ibadan building, okay, let me see what they wrote here. The capital gains arising in the Lagos building is exempted from capital gains tax because it relates to compulsory acquisition of the property by an authority that has the power to do so. So it means that because the government took over the property by force, because they want to build a road, it will not be made to pay capital gains tax. from your gains. This is because you did not voluntarily sell. This is a compulsory takeover, or in the case here where it was destroyed by fire, as we said, it will not suffer capital gains. Now, the other one had a capital gains tax. That's why it was the people decided to sell because of their fear. And so they have to suffer the capital gains tax. All right. So the C part states one other alternative open to General Investment Limited in discharging its capital gains tax liability and the time limit for exercising this option. So this is the rollover that they want you to do. So the first one here was an assumption of no rollover, that you just sold the assets, you pay your capital gains tax. But in this case here now, we're talking about rollover. So the company can discharge its capital gains tax by claiming rollover relief from the disposal of Ibadan building. The full rollover will be granted if the whole consideration, 15.5, obtained from the sale of the building is reinvested in the Ogun building. So you see here, this 15.5, although we have deducted 3.25, but this whole 15.5 is your sale proceed. If it is lower than how much we are buying the new building here costs 20,500,000. So it is lower. And because it is lower, this 1.4 million that was capital gains tax will be saved because it will be a full rollover. That is what they are saying. So the full rollover will be granted if the whole of the consideration of 15.5 obtained from the sale of the Ibadan building is invested in the construction of the Ogun building. The time limit within which the proceeds from the sale of the old asset must be reinvested is a period beginning 12 months before and 12 months ending after the disposal of the old asset. So you can start counting 12 months before the disposal of the old assets and still count 12 months after the disposal of the old assets. So in fact, if by the 12th month after the disposal of the 12th act of the assets, there is no reinvestment, then the full rollover will have elapsed. Please note that the tax law did not specify the time limit for claiming rollover relief. This is kind of contradictory because we are saying a reinvestment should occur between 12 months. So if reinvestment occurred after 12 months, how are you going to claim your rollover? It's fine. They said, please note that the law did not specify time for claiming the rollover relief, but the law specified time for reinvestment into the new assets. It's just like saying that ICANN does not specify when you are going to register for as a student. You can register anytime. But ICANN specify the deadline when you pay for exam. And of course, you cannot register for exam without becoming a student or registered member of ICANN. So it is you using your tongue to count your teeth. If you want to write your exam, you have a deadline. If you want to be a student of ICANN, you don't have any deadline. You can even register anytime. Even on exam day, people register to become student of ICANN. But you have to, first of all, get that registration number before you now apply for exam. So one way or the other, one is restricting the other. Okay, so let's look at that number 4, that of Dr. Mensah. So that's number 3. Okay, we've done this as a result of the last class. This is meltdown. This is meltdown. I think we've done something like this. Okay, so this one here, meltdown, is higher purchase investment. Okay, so let's explain this meltdown again. Meltdown Construction Limited purchased a bulldozer on hire purchase on February 1, 2007 and paid 28,500 as deposits on the purchase price. So this is the initial deposit. The cash price of the bulldozer at the time of purchase was 45 million. But Meltdown Construction was allowed to pay the balance in 20 monthly installment of 1,000 each with effect from March 1, 2007. Now calculate the capital gains tax, assuming that the bulldozer was sold for 48.4 million after the payment of installments on December 3. So note, installment was due every first of the month. So it means here that an installment here was paid in December 1. Then after the payment of this installment, the asset was sold in December 3. That's what we are asked here. And here, the installment was made in September 1, and the asset was sold September 5. Okay, so let's see how this can be handled. First thing to do is to get your expected payment. Meltdown Construction, that is number 4. So let's use this now. Meltdown Construction. So I will say expected payments. So your expected payments, how much are you expecting? You are finding out. We have initial deposits. Initial deposits. How much is initial deposits? The initial deposits here, we are told, is 28.5 million. So this is going to be 28,500,000. Monthly payments, monthly installments. Monthly installments, we were told that 20 monthly installment of 1 million. So it means this is going to be 20 times 1 million. That will give us 20 million. So something else comes to my mind. This initial deposit was made in February 1. February 1, 2007. Monthly installments was beginning from March 1. So I will write here, March 1, 2007. When will it be complete? So look at the way I do things. March to December is 10 months. So it means January and February have passed. So March 1, 2 months passed. So 10 months till December ending. Then we said it is 20 months. So from March 1 to December 31st is 10 months. So the 11th month will start from January. So we need another 10 months. So from January 1 till October ending, the remaining 10 months. So this is from March 1 to, that means the last payment should have been in October 1. The last payment should be in October 1, 2008. Okay? So you've calculated the 20 months installment period. So you add them all together and you are having 48,500 or 48,500,000. This is your expected payments. So after getting that, you're going to remove your cash price less cash price. So what's your cash price? Your cash price is the purchase price that you would have paid if you are not doing hire purchase. If you are trying to buy the bulldozer as at the time of purchase, you would have paid 45 million. So that's the cash price. You remove 45 million. So when that is removed from 48
You wrote 48 instead of 40. You wrote 48 instead of 45 cash price.
So sorry. So this is 45 million. So when you remove that, this is going to give me 3.5 billion. So this is your hire purchase for the period. Okay. So hire purchase for each investment will be hire purchase per installment will give us 3.5 million divided by 20. That should be 1.7, 170. 170. Let's see. 3.5 divided by 20. 175. 175. So it's going to be one.
Hello, sir. Hello, sir.
Yes, I'm with you.
Expected payment less cash price. Is it not supposed to be interest?
I didn't get that.
Expected payment minus cash price. Is it not supposed to be interest?
Supposed to be what?
This 3.5. Is it not supposed to be interest instead of higher purchase for the period?
Yes, it's higher purchase interest. That's what I mean.
Okay, you say higher purchase interest. Thank you, sir.
This higher purchase interest, I mean, HPI by installments is 175. So this is the interest you are making for each time you are making your payment. Remember, you are paying 1 million each time. So what you are going to do now is you're going to look for the capital payment. So capital payments per installment. So amount paid monthly. So that's 1 million. So less interest by installments, which is 175. This should give us something in the region of 825. Let's see. We have 175. If I had to remove 1 million from it, 1 million minus 175, that should give me 825. So this is your capital payment. So it then means that for year of assessment 2007, let's see, yes, 2007. For 2007, what is going to be your sales proceed? We sold it for 48,400,000. 48,400,000. Then your cost of acquisition. Now you sold it on December 3. So that means you would have paid 10 installments from March 1 to December 1, including okay, so cost of acquisition would be the initial deposit, which is 28,500. Yes, 28,500. 28,500 was the initial plus 10 months multiplied, instead of 1 million, multiplied by 825. So what it means here is 825 multiplied by 10 months, that is for the monthly installment 8.25, plus 28,500. That is what was paid, 36,750. 36,750. That's your cost of acquisition. And that's going to give me 0, 0. Let's do it together here. If I were to minus it from 48,400, I'm getting 11,650. So this is going to be 11,650. 650,000. So that is going to be your capital gains. So your capital gains tax at 10% will give me 1,165,000. All right, so the next one is if for year of assessment 2008, assuming that it was not sold in 2007, that it was sold in 2008, and we were told that we sold it in September 5. Mind you, in September 5, we said the whole thing would have ended in October 1, meaning that only 19 months was removed. 1 month is remaining. Now, there are two ways we can do it. Since it is 1 month, it makes it easy for me. All I will just do here is sales proceed. Sales proceed is 49,600. 49,600. Now say less cost of acquisition. All I will just need to do is how much is the cash price? 45 million. 45 million minus 1 month's money, 825. Let's see. 45 million minus 825,000. That would have given 44,175. 44,175,000. That's one way of doing it. Another way would have said, or let's do it the other way. 28,500,000 plus 825 times 19. So let's see. 825,000 times 19 months. Now add 28,500 to it. It gives us the same thing we just did, 44,175. So it gives you the same thing. So when you less this, what you're getting here, 49,600. 5,425,000. 5,425,000 is 5,425,000. That happens to be your capital gains. So that's your capital gains. Then your capital gains tax is going to give you a 10%. This will give you 542,500. All right, so that's it. So we have seen all the scenarios. So I need to re-emphasize some of the things we've learned in this chapter. One, we've seen that capital gains tax is 10% on capital gains and is chargeable on actual year basis. Secondly, we've seen the format for simple capital gains tax, where we have the amount received as sales proceed less cost of acquisition. That will give you capital gains, and we now take 10% of capital gains as chargeable. Next, we looked at 3 other scenarios. The first one is hire purchase. Look at hire purchase scenario whereby you are making initial deposits and you are also making monthly installments. Now, both the initial deposit is a capital payment, but the monthly installments contain both capital and interest elements. So you need to strip out the interest element out of the capital elements so that you can only use capital elements for cost of acquisition. And for you to do that, you need to know your expected payments less the cash price so that you get your total interest for the period. Then you get interest by installment. When you get interest by installment, you remove that interest by installment from each monthly installment to get capital payment by installment. And so the thing here is if you sell the asset or dispose it before the contract period expires, you need to count how many months within the contract period, and you calculate the number of capital payments you've made for that period for able to get your cost of acquisition. But if you have finished paying, so you will not need to do all that. All you need to do is get the purchase price as your cost of acquisition. Then we looked at another scenario, which is part disposal. We look at a situation whereby you are using your item for trading purposes, and you bought them as a single item. You paid for everything, legal fees, other fees, but now you are disposing them parts. There are some expenses that is enjoyable by all the assets. But because you are disposing parts, you need to prorate that part. Also, the cost of acquisition needs to be prorated. And so when you see partial disposal, you know you're going to use this formula, A over A plus B, all multiplied by C. So that's the way. Then the next one is roll over. And I use an example of Ikeja house disposed of to get Ikoyi house, which is higher than what you sold the Ikeja house, and also higher than your cost of acquisition. In that case, the amount of sales proceed you invested or you received is smaller than the new investment you made. In that case, there is a full rollover. Now, in the case of Ikeja house sold and you're going to buy Ikosi house, the amount you receive from the sales is smaller, okay, it's bigger rather than the amount that you invested in the Ikosi house. And so your reinvestment was lower. But the amount you invested is higher than the cost of acquisition of the old house. In that case, you have a partial rollover. But in the case of Ikorodu house, where both the sales proceed and the cost of acquisition is even bigger than how much you invested in the new Ikorodu house, then a no relief is granted. And take note of the time period, 12 months before the disposal, 12 months after the disposal. Then we look at asset that was taken away by fire, compensation was paid, and also a land taken to you from the federal government or the state government by force. They give you compensation. If you calculate your capital gains, there will be no capital gains chargeable. So we have come to the end of capital gains tax. Now I want you to do something. I want you to go to every diet of ICAN past question and treat the capital gains tax in them for the last past 5 diets. So that means you have 5 questions on capital gains tax to play with. Treat them back to back to back. And let's discuss if there is anyone that is giving you an issue. All right, with that, we come to the end of today's class. By the next class, we'll be taking a new topic where we'll be interesting. It will be an interesting topic, just like this one was. So at this point, if you have any question, feel free to ask. Otherwise, the class will end now. Okay, so the class is going to end now. There's no question. So thank you so much for coming to class. We hope to see you in the next class.